Thanks, Grace, for giving time. I really appreciate you coming on and spending your time. I think it's just good for to hear a bit on your introduction and what you've been an investment banker earlier. From your I read some of your profile.
Sure, I'll give a quick intro, and thanks for having me. I'm excited to talk to you. So I started off my career on the banking side. I was specifically in the oil and gas space back in 2014 when oil was at their all-time highs. And over the course of about 9 months from when I joined the firm, oil went from $100 down to about 40, down to 30. So deal flow dried up. That led to my next opportunity, really working for a private equity firm, for two private equity firms, really, trying to do a dual track process, leading a behavioral health company, either public or to a private, to a sale to another private equity firm or to a strategic. That ended up actually resulting in a restructuring, which was a really formative experience for me at a pretty young age. And I had a lot of responsibility and learned a lot, which was exciting, but not what I was interested in. I was more interested in growing companies, not turning them around. So after that process was done, I got a job at a family office where we were focusing on buying, and mostly buying, not really selling, long-term care facilities. So everything from skilled nursing, assisted living, independent living, and I'm not sure if you guys have those over in Singapore, but essentially it's where older people can go to stay as a community. And for skilled nursing, there are actually nurses there to take care of the sick elderly. So that's what we were doing, buying both the operating and property companies. And this was really the foundation for my skill set today, where I learned how to understand and break down a business from the ground up and top down. So we were doing extensive and detailed operating models, 17,000 lines long, and really understanding every single nuance of the business. And after 3 or 4 years, my interest and my passion was always in the public markets. My path just kind of led me towards the private side. But after about 4 years, I kind of made the decision, right, that I didn't want to be comfortable with my salary anymore, and I wanted to really go after what my passion was and what I love to do, which was, be a public market investor. So I left and I started my career in the public markets. And so my whole framework really revolves around trying to bring a private equity lens to the public markets in terms of the level of analytical rigor and just mental models and frameworks that I use. So in June or July of this year, I started getting involved more on Twitter and really developed a really cool network there, met a lot of great people, started sharing my ideas, and that really started to proliferate. And then I started a newsletter kind of to piggyback off of that, and that's also done pretty well as well. And I was doing pretty frequent newsletters when I first started. Because of it, ironically, I had more inbound requests for different projects. So it kind of came to somewhat a slower pace. But this year, I'm really focused on making sure I get at least one newsletter out per week.
Thanks. It's really fantastic. I mean, I've read some of your newsletters, and now I follow you on Twitter. And I think it's amazing. You're doing really, really good job educating people and sharing your thoughts. So thanks for that. Now, I think one of the things, Chris, coming back to, people, investors like me or any investor, they want to beat S&P or they want to beat NASDAQ, whatever, and they got to generate certain alpha for that. How do you do that? What's your secret sauce for that?
Well, I wouldn't say I have a secret sauce per se. I think that there's a certain way that I believe investors that are professionals should approach investing, because to really go about the right process takes a lot of time, a lot of energy, and a lot of work. So somebody that has a day job outside of the public markets, it's very hard to be an active manager because you're at an inherent disadvantage given the time constraints, right? So my comments are very much geared towards people who do this for a living, who are in the markets, public markets for a living. And so if we start at a very high level, the way that you need to think about investing in the public markets, and this is something that I had to really change in terms of my own thought process coming from the private side, was that it's not about what value you believe the company is really worth. It's about the value that you believe it's worth versus where it's currently priced today, and then what the expectations are for the company, right? So what we're trying to do, and the best way to generate alpha, and I'm talking about long term, because in this market, which we can talk more about as well, it's been, I would say, very easy to make money. You know, you find a high growth stock in terms of their revenue, or a SPAC, you put money into it and you make money. Now, that's not how it's going to be forever. That's how it is right now because of certain monetary policy and just a lot of liquidity in the market, which does drive markets. You know, there's no doubt that liquidity is the main driver because it's all about supply and demand. But as an investor, we're trying to play a longer game, right? We're trying to really be owners of a business. So how do we then do that as a true investor, not a speculator? Well, the first thing you need to do is, once you find, you know, a stock or an opportunity or a theme, is determine what your differentiated perspective is on the stock, right? What do you think about its critical factors, what really drives the stock, as opposed to what consensus is? So what is the buy side thinking? What do sell side analysts include in their estimates? What do you think that's different, right? Your differentiated perspective. And what you need to really have a good grasp on is why they are wrong or why you're right. Either way you want to look at it. And the way that you have to do that is very quantitative, right? So what you need to come up with are quantitatively verifiable metrics or results that you can benchmark to, right? And I call these critical factors, right? And you only want to have, really one would be ideal, but 1 to 3 or 1 to 4 critical factors that drive a stock. Now, every critical factor is going to have an associated catalyst. That catalyst is something that happens that makes the street, you know, the sell side and the buy side, come towards your view of the critical factor, which will make the stock's value move towards your estimate as opposed from theirs. And so everything that I do, my entire process, is really trying to find what those critical factors are, what my differentiated perspective of those factors are based off of deep research, field research, talking to experts, et cetera, and, you know, quantifying it, understanding what is priced in or what the sell side and buy side believe. And if there's a difference there, which a lot of time there's not, a lot of the time, you know, I'm coming to a pretty similar conclusion as, you know, the analysts. And in that case, there's no point in me investing because I don't think I have an advantage. But if there is, right, then I have a very good understanding of what those critical factors are, what the catalysts are. So as I'm going through time and each quarterly report, or there's an event that occurs, like an investor day or whatever it may be, I'm able to track my thesis very easily to what's actually happening in the market, right? And so I very much believe in a long-term perspective, and that's different for some people. It could be 12 months, 15 months, 3 years, I don't know. And I think a lot of it should depend on the company itself.
What's your long-term perspective? How do you define?
Sure. So like I mentioned, it depends on the stock and the industry. So for technology, and there have been boatloads of studies, you're really only seeing a company being a true market leader or being, you know, outperforming the market over about really 1, maybe 2 market cycles, which you can think about 12 to 15 months, maybe 18 months, right? So for those higher growth, SaaS, those technology names, that would kind of be the time frame, right? But for something like a alternative energy company, right? Or even a Unity, for my thesis on Unity, those are longer term theses that have to take time to play out, right? And so then you're going to get into a whole other discussion in terms of longevity of capital, alignment with LPs, if you're managing money. But, and so the answer is that it just depends on what type of stock it is and what your catalysts are, when your catalysts are. So your catalysts have to occur within your investment horizon. So if I have a investment horizon of 12 months for a technology stock, right? My catalysts have to be within those 12 months, or there's no way for me to track if I'm right or on the right track, right? So that's what it's all about. And so what I'll do for every company is really just develop a one-page the summary, right? I'll have where the market is, where it's currently trading, how it's currently valued in the market, really high level based off of my modeling and just a high level understanding of the stabilized unit economics and what I believe normalized earnings are, what my projection is in terms of value over a certain time frame, and what that implied IRR is. You know, what does that imply in terms of my returns? And then the meat of that one pager is it comes down to this thesis and the critical factors. So what is my thesis, my differentiated perspective, and what is each critical factor? What is each quantifiable, quantitative, verifiable metric that I want to focus on, and what are the catalysts? And so as being a long-term investor, really what that is, and Dennis Hong said this from Shawspring Partners, it's really just the accumulation of a lot of correct short-term decisions. And so that's the way that I'm approaching it. I don't play the quarterly earnings game, but I use quarterly earnings to just track my thesis. And so that's how you can really generate true alpha over the long run. It's developing a differentiated perspective that's different from consensus, and it's being right. It's those two things you need in order to generate alpha in the long run.
Nice, good to hear that. Now let's come to some of your picks. What are the picks you are studying these days, which you think are, which probably could outperform the market, or which already are outperforming the market?
So if you want to talk about some names that I previously invested in using this process,
Yep.
Crowdstrike was the first one that I really focused on. Crowdstrike, when I think it was in the 80s or so last summer, 80s or 90s. That's when it was the first stock that I ever analyzed when it came to the public side. And I pretty quickly came to the conclusion that it was a home run. And so if we want to talk about why, so I want to say one thing really quickly too. If you're spending a lot of time doing analysis on a stock and you're needing that more time to develop conviction, usually there's something wrong where, because I think that a good stock to own, it's going to become apparent pretty quickly. And this is what happens.
Story gets clear very soon.
Yeah, it's like you're trying to convince yourself, like,
it
it's a good
work.
stock, like find the reason why. It's like data mining bias, right?
Yeah,
it's the same thing. So Crowdstrike, it happened pretty quickly for me. Now, you can check off all of those typical SaaS metric boxes, right? It was growing at plus 80% year over year for every quarter, and it had come down from about 100% or so, but still 80% plus is, that's top echelon in the SaaS space. It was developing free cash flow margins that were positive. So already, free cash flow positive. The rule of 40, which is a SaaS metric that says you want your revenue growth plus some profitability margin to be greater than 40%. It's a rule of thumb. I don't know if it's very accurate, but they were at like 90%. So they were really taking that to a whole other level. And so, all of the financial metrics were checking out for me. And it was very exciting to then see that juxtaposed to the metrics in the market. And a lot of people look at enterprise value to sales just viscerally. But I think that kind of misses the whole point, because any company can generate sales if you just plow in a lot of sales and marketing dollars, right? And so if you generate a lot of sales, but you're taking that all away in your operating expenses, what's the point, right? You can't, there's no value add there, because at the end of the day, the value of the company is really what they can return to stockholders. So what I was seeing though is that Crowdstrike is actually extremely efficient in their marketing spend. And there are a couple different metrics you can use to analyze this. One is, and it's a pretty standard metric, I think, across the industry. It's called a magic number, which you can think about it just as what are the incremental revenue dollars that they gain from their sales and marketing dollars, right?
Yeah, yeah,
This
yeah,
is
yeah,
return on investment, basically.
yeah, yeah, yeah.
And anything greater than, I think, 0.8 is good. And if you think about just one, it's basically for every dollar you put in, you get a dollar out, right? They're at 1.4, which is really impressive. It's very high.
That's
It's
huge.
one of the highest in the space.
Mm-hmm.
And then the second metric is what you can call LTV to CAC, so lifetime customer value to customer acquisition cost. It's another way to measure return on investment. And it does require a pretty big assumption in terms of the stickiness of the customer, how long they're with you. But if you benchmark their LTV to CAC ratio against the rest of the SaaS names, they are far and above better than everyone else. They were like at 8 times. That's
Yeah,
unbelievable.
yeah.
And so I'm building my mosaic and figuring out all these different positive values with the company. I developed a model, came up with some stabilized earnings based off of what their stabilized unit economics should be. I talked to some industry experts that really know the cybersecurity space better. Well, of course, better than me. I was very new to the space. And when unprovoked, unsolicited, everyone kept mentioning CrowdStrike, it's another great data point for me. And then understanding why, it came down to a few things. One is that the product is easier to use. And I think that the user experience is something that a lot of investors don't focus on, but they should, because at the end of the day, how something makes you feel, you develop a connection to it and you want to use it more, right? So that was a big positive. They are using more of a bottom-up approach to sales and marketing, and they have both. They have different types of sales teams, but they're getting in at the developer level in these companies who are starting more and more to make the decisions on IT spend. So they were getting into the ground level, and you were seeing that flow all the way up. And the way that you can see that is through their dollar-based net retention. It was always greater than 120%. And so the easy way to think about that is that if they didn't grow, if they didn't do any new business for the next year, right? Zero incremental revenue, they would still grow at 20%. That's pretty impressive,
That's
right?
insane.
And then you start connecting the dots. Well, that's no wonder they're growing at 80% year over year. Then they have fantastic margins, et cetera. But what's the competitive advantage? Because that's really the key, right? Any company can generate great returns for a period of time, but is it sustainable? Is there a protection around there? And what I came to understand is that their competitive advantage all revolves around this data lake, which then uses artificial intelligence
Yeah.
to protect all of their customers, which is called their threat graph. And so what they did that was unique from other companies previously is they crowdsourced all of the data from all of their customers and they fed it into this threat graph. And then any sort of learnings that happened in that threat graph, they could apply to all of their other customers. So if you think about a flywheel effect, right? The more customers they get, the more data they get, the better their algorithm becomes, because AI algorithm is directly related to the quantity of data that you get. So it's the better algorithm, which is a better product, which gets you more customers, which gets you more data, et cetera, et cetera. And you see it just keep going and going. And so that was kind of my big realization there, is that they have this competitive advantage being their network effects of having crowdsourced data and using artificial intelligence, which then led me later down a path of really doing a lot of deep homework on
I
AI.
read your stuff on artificial intelligence. It's
It's
super helpful for me.
it's absolutely fascinating what the industry is doing. And so that's why that's why I became a big CrowdStrike bull back around the 80 or 90 range. And I've been trading around the position, but I've held it since then, and it's been a great stock for me. Now it's the more that a stock goes up, the lower the forward returns are, right? And that's all else equal. But what you see is that these higher growth names, right, they start growing into their valuations pretty quickly. And so the question really becomes, well, how long can they sustain this growth? And so that's really dependent on, who you talk to, how you foresee the business playing out. But what they're doing is they're really expanding across the tech stack in terms of cybersecurity, and they're developing more experience in zero trust, which is incredibly important. It's part of the new cybersecurity paradigm. So they're really getting all of their tentacles in the different cybersecurity spaces and developing a holistic offering. And then on top of it all, like their pricing model is exactly how I'd want their pricing model in terms of how to really create value from all their opportunities. So really everything just is pointing towards CrowdStrike continuing to be really a behemoth in the market. They continue to take market share from the old incumbents. That's really been a name that I've been extremely bullish on.
Yeah, no, I think I've been following Motley Fool, David Gardner and Tom Gardner. I think
Yeah,
two great investors, and I think they've been very bullish on CrowdStrike as well. And it's something I studied the company. I really like the company, and I think something about the Russian attack or something they've done something
yeah,
good.
sure. So they really became famous back in 2016 when they were called in to investigate the Russian hack of the DNC. And so
Yeah.
they were the company that, was called to do that. And then similarly, the recent attack on FireEye and SolarWinds, CrowdStrike was the first company that SolarWinds went to hire to investigate the attack. Because what CrowdStrike does is they do prevention and they do detection as well. So what they did is essentially they were called in to really understand what happened and to see what was compromised. And so they're constantly the company that different companies and customers are turning to for their cybersecurity solutions.
Oh, that's really cool. And what's your time horizon on that? What's like how long do you plan to hold it? I think.
So to think about it this way, when I started, right, I had a 15-month time horizon. So if I started in it was I think August of 2020. So that would take me to say the end of this year, let's call it. But what I'm constantly doing, right, is like my analysis is not static. It's dynamic. I'm constantly updating it, right?
Mm.
So if my thesis is continuing to play out and the stock is continuing to perform and the company is continuing to perform the way that I expected to or wanted to or even outperform, I'm not going to sell it. If you look at the true market leaders and the big market winners over time, they're the stocks that just keep going up.
Yeah.
And so
Yeah.
until something happens that changes the story for me or my thesis is proven wrong, I'm not going to sell just because maybe it hits some arbitrary price target. It doesn't, that's not how I think investing should work. I think that price targets are good directionally, but you want to be very careful about, false precision because, and this is the analogy that I give to people, I don't know, and I have complete control over this. I don't know what my bank account is going to look like in 12 months, how much my savings will be, et cetera. And there are not a lot of variables that go into that, right? And it's mine. I should know it better than anyone else. So, how am I going to really know to the dollar or even to, let's call it 5%, what a very large company, dynamic company is going to look like in 5 years? it's really hard to do. So it's more directionally that use price targets. And so I'm not selling unless the story really materially changes.
Are you kind of buying it? Are you kind of a, dollar cost averaging, or are you net buyer
No,
these days
so
at the higher prices?
yeah, no. So the way that I approach my portfolio management is, let me talk about it this way. Really 80 to 85% of my buying decision is fundamental. So
Okay.
it's the company, it's the modeling that I do, et cetera. And then and that tells me what to buy, what stock to buy. The 15%, the other 15% is really trying to find these patterns, these stock patterns that historically, empirically have had high probabilities of being a breakout or of it going up from there. And it's very much a can slim Bill O'Neill methodology, where I'm looking for a stock to break out of a base pattern.
Okay.
And so that's important because, like, I'm not trying to necessarily market time. It's not what I'm doing. But I do believe, and this is another part of my portfolio management framework, that you want to cut your losses short and let your winners run. And what that allows you to do is develop a positive skew or asymmetric return profile, right? So I have max loss rules for every position. So if I have a max loss rule of, say, 7 or 8%, it matters a lot when I enter the position, right? And so that's why I use some of these higher probability stock patterns to determine my first buy. And so my first buy will be, if I have a target of, say, a 12% allocation to a position, I'll probably make my first purchase of like 6%
Okay.
of my portfolio, which is
Okay.
50% of the total position. And then over the next 2 or 3%, I'll add the next incremental 25%.
Okay.
And then over the next 2 or 3% after that, I'll add the remaining 25%. And so what that's doing is it's allowing me to take a position and then let the stock prove to me that my thesis is kind of playing out and the market is agreeing with kind of where I see things going. And so I build a full position as the market is confirming kind of my thoughts around the stock. Now, this is probably a longer conversation for this podcast, but there are certainly different indicators on the selling side that will tell me when to take some profits, or to not, and to let it kind of run, right? And then you also get into certain things like rebalancing, and like I mentioned, when a stock goes up a lot, the forward returns come down a little bit.
True.
So there are some nuances there in terms of managing the position once I have a full position. But I basically build a full position over the course of however long it takes to go up about 5% or so from my initial buy point.
Nice, nice. So that's good. I mean, what is other favorite investment of yours? Crowdstrike. I mean, I'm also vested in the company, and it's been growing, which is good.
Yeah.
What's the other
So
company you're looking at, which kind of fascinates you?
So I think, a good one for us to talk about. There's some more under the radar ones, which is what I'm trying to focus on more, because, I think that what we're seeing in the market overall is a lot of, let's call it concentration or overcrowded trades. So I'm trying to focus more on the more under the radar type of stocks. But one that I think would be interesting for your viewers is C Limited.
Yeah.
That's another stock that I analyzed a little while back. Uh, I forget what price it was at. It was probably in like the 140s or something like that.
No, it's 200 plus.
Yeah, now it's 200 plus, right? And it became, once again, I've mentioned CrowdStrike, how pretty quickly it became obvious how great of an investment it was. C was another one where it was almost obvious from the start. So I analyzed C right after I did Mercado Libre, which
Yeah.
is the myth down in Latin
Latin
America.
America one, yeah.
Right, right. And during my research on Mercado Libre, I came across C because of C Limited's, foray into Brazil, where Mercado Libre is the dominant player there. But when I'm looking at, web traffic for searches down in Brazil, I'm seeing C Limited going up, and Mercado Libre is still at the top, but C Limited is catching up and then kind of surpassing
Yeah,
them.
the growth is higher. Yeah.
So it really piqued my interest. So I started looking into C, and C Limited is, I think, a name that it's not underlooked, or people, they don't maybe not necessarily know about it, but it is a stock that has so much more room to run despite its great success so far. And if people don't know too much about C Limited, I'll give the quick rundown. So the CEO is Forrest Lee, who, in my opinion, he's one of those great CEOs out there that actually a lot of people don't know about. And what's interesting is that he was actually inspired to become an entrepreneur after listening to Steve Jobs talk
I read about that. Yeah.
Right.
Yeah.
So like that start alone, I love the story.
Yeah.
And so he started a company that I think it either wasn't successful or he sold it, but then he started Garena, which was started off as a gaming company. And over time, Garena just kind of became rolled up into C Limited. And so Garena is their gaming division, or what they call digital entertainment. And that is what you would call their cash cow. So that is what generates really all of the cash flow to fund their two other ventures, which is one is Shopee, which is their e-commerce platform. And the other is C Money, which started off as AirPay, but it's like their digital wallet, digital banking product. So what they're doing, and this is the Amazon model. I don't like saying it's the Amazon of Southeast Asia or the Amazon of Africa for Jumia. I don't like doing that. But part of what I do is I use mental models in my process. And what that is it's understanding business models that have been successful and then identifying those in other companies. And C Money and C Limited is doing that, the Amazon model in Southeast Asia, meaning they're taking their main cash generator and using it to fund their other businesses, right? Because right now, Shopee and C Money, they're losing money. They're on an EBITDA basis negative, but that's because they're scaling. So it makes sense. People, and this is the differentiated perspective. A lot of people view C as, well, it's just one positive, division, but then they're just losing a ton of money in these other divisions. They're missing how, growth works, which is you have to fund these businesses and start off at a loss as you're scaling. Like if you think about Amazon back in the 2000s, everyone was hating on the stock because they were losing a bunch of money on a cash flow basis. But what they were doing is they were plowing all of the earnings from one main business, from their cash cow, into their other businesses, which now look at what's done for the stock. So C is doing the same exact thing with Garena really funding Shopee and C Money. Now, Garena, if we just want to go quickly across the different divisions, Garena it started off as more of like a distribution platform for games. And so, Tencent, I think initially had like a 40% stake in Garena, and now it's down to, I believe, like 28 or something around there. But basically, C was the distributor for Tencent Games, which is, I think, the largest gaming company in the world.
Yep.
What they started doing, though, is also developing their own in-house games with, Free Fire was really their first big hit. And if you look at, you're using App Annie, which is a service that tells you, app downloads, etc. Free Fire is one of the top mobile games out there, right? And so you have it on the actual gaming side, and I'm a huge bull on gaming overall because of really two things. One is overall internet penetration in the world still has a long ways to go. Currently, only 50% of the world, or about 4 billion people, have access to the internet. that's expected to go to around 90% by 2030, which is an extra 3.8 billion people. So you have 3.8 billion more people getting access to the internet. Overall, internet is consuming more and more of our time, right? If you look at trends from 2010 to now, every single year, their time spent on the internet is going up, and mobile is capturing more of a percentage of that as you have smartphone proliferation and the quality of smartphones improve. And then when you look at exactly what people are doing, how they are entertained, you're seeing trends of video and TV and music coming down and gaming going up. And then you look at demographic bifurcations, and the younger generation is spending almost all of their time on gaming as opposed to kind of older generation. So you have this tailwind of this new population coming up, which are all going to be doing gaming. So Garena really capitalizes on that trend, right? So the industry is a great trend. They have a great business model in terms of the distribution and then also their own in-house games. And that's on the actual game playing side, but they're also maximizing this new trend of esports, which is viewing sports, right? And a couple of years ago, there was Netflix and YouTube released basically viewership metrics where it was like 50 million people were viewing movies, but the same amount were viewing games. Like that's incredible, because I never thought about that. I don't watch games, but that's a new and evolving trend that's really actually surpassing a lot of your traditional sports. Like the NFL is actually, I think, the only sport that is viewed more than esports. That, like, it's crazy to me, because in America here, it's like, you have football, baseball, basketball, hockey. You don't think about esports necessarily unless you're really focusing on the space. And then if you think about just culturally, and you can correct me if I'm wrong here, but what I understand is that culturally, people in Southeast Asia are a lot more attracted to gaming and esports because it's a level playing field. You don't have to be 6'4", 250 pounds to be a successful gamer. You can be anybody. It's all about the time you spend, your skills, etc. So gaming itself is a huge trend that Money is really leading in the region, right? And then if you think about just the internet economy in Southeast Asia, I mean, it's going to be growing at like a 20+% CAGR over the next 10 years. So all of these tailwinds are really positive for gaming, but also for e-commerce, right? And so now for e-commerce and Shopee, they're doing so many amazing things that it's once again to take too much time on this podcast. But I think the message I want to get across is that I spoke about network effects for Crowdstrike. It's a common thing I look for in my investments, and it's the same exact thing for C Limited. You have the network effects being, if we talk about just gaming, you have your actual gamers, which join the platform, and then you have your people who just view esports. But if you're all coming onto the same platform, you're going to have the people that are viewing esports become gamers and vice versa. So you're getting more people onto the C Limited platform that way. Those people will start using the e-commerce platform because it's what they're used to, it's what they're familiar with. And with more people using the e-commerce platform, obviously it's helpful for that business to scale. But also you're seeing more and more that C Money is becoming the financial medium for the payment side of Shopee. So you're getting more people onto the platform, which are then using through Garena, which are then using Shopee, which uses C Money. And C Money is also used for Garena as well, because more and more the way that these gaming models are turning out is that it's really all about in-app purchases. And
C
so
Money is a huge competitive advantage for them.
a huge competitive advantage,
Yeah,
right?
compared
And
to.
recently they just got their banking license, their digital banking license in Singapore, which is huge for them because the entire region's underbanked. So if a person can use their mobile phone to bank, that's a huge advantage, one, for the person, but also for the entire economy, because there's a pretty direct correlation between the banking nature of the economy and the economic growth itself. So that's C Limited. It's really it's a stock that at a company. I think that I don't want to throw out just broad strokes, but it can become about $1 trillion company if they continue down this path that's similar to Amazon. They have that potential. And so that's why it's one of my kind of longer term holds. I'm of course, and the growth is staggering, but I'm continuing to track it every quarter, make sure that it's, sticking to my thesis. But it's a name I don't intend on selling really anytime soon.
This is amazing, and Chris, I was telling you that C Limited is highly, you know, under leveraged, or I would say that it's not very high profile in Singapore. I mean, the CEO, you said Robert Lee,
Horsley. Yep.
Forrest Lee is not somebody who's extremely high profile or talked about. That in a way is a positive because I think the company is more bothered about creating value, for the business for its shareholders
Yep.
than finding the eyeballs in the TV or the newspaper. So
And more
that
importantly, shareholders too, I'd want to add
yeah.
that he is acutely focused on the customer experience, which is something I love about him. And that's
Yeah.
more important to me than really being shareholder focused.
It seems that the company is what I was reading somewhere that they've not taken private equity or a venture capitalist. I mean, the funding is not, they've not sold their stake to a private equity or a venture capitalist. That gives them a bit of a, leverage to be a bit more long term rather than, living for next 2 years or 3 years or 5 years. They probably, if they think in terms of decades, they probably can grow better and more, you know. Those are a couple of
Exactly.
things, yeah, I've heard
Yeah.
about them. So I think it's a very good company. I read more into it. I really get fascinated by the three legs they've created for themselves, and
Yeah, exactly.
that's nice. Tell me a bit. I think we've a couple of 10, 15 minutes more on us. What are the new other companies? Because you seem to be looking for the companies under the radar. What are the companies you are looking at, or what is the company, one company or two companies you're looking at, and which you probably would think that can benefit other people as well.
One that's been on my radar and I haven't pulled the trigger yet, but I'm watching closely. It's a company called nCino.
Mm-hmm.
So nCino, you can think about, and the ticker is nCino.
Okay.
And so what you can think about nCino as is essentially a CRM
Mm.
for financial institutions. So like think about uh, Salesforce, the company, but really focus on financial institutions. And it's not
Okay.
just the customer relationship management
Mm-hmm.
platform, but what they also do is stuff like
Mm.
customer onboarding, account
Mm.
openings, loan origination, deposit accounts, etc. Really trying to capture the entire operations of a financial institution. And so what I'm trying to still figure out is really once I talk about this competitive advantage, like what is
Mm-hmm.
their advantage? Are there other players in the industry? I'm still doing my homework there. But the the industry trends and kind of the more top down approach is really positive for me, because what I didn't know until I started looking into the company is that if you look across all of the industries and what their IT spend is, financial institutions actually lead the pack. They spend
Mm.
about $376 billion in IT spend in 2018, which is it's staggering. And nCino only claimed that their total addressable market was about 10 billion. I think they're being conservative there on purpose. But there are a lot of really positives to look at when it comes to nCino, which is, they have relationships with about over 300 financial institutions already, a lot of,
Mm.
or 920 financial institutions, I should say. And a lot of them are actually some of the big banks. They have Bank of
Mm.
America, Barclays, TD. So their customer base is really strong. And when you think about the financial institution industry in light of COVID-19, that's one of the main industries where it would be highly affected by the pandemic, and they would be cutting back all of their non-discretionary spend. So what that would then tell me is that, well, then nCino should take a big hit, right? They shouldn't be able to perform very well through the crisis, but actually they still maintained about, it was north of 40%, around 50% revenue growth over that time. So you can only imagine what's then going to happen once we come out of the pandemic, right? And banks can actually start actually spending more on their IT again, but also as the banks realize that digitization is critical, right? In order for business continuity. So I think you're going to see nCino really get a huge boost from, you know, the kind of post-COVID tailwinds. And so that's a name that I'm really watching. I forget what it closed at recently, but when I was looking at it, it was right around 69 last
I
week.
saw that the stock price is pretty much range bound for a long time.
Yeah.
I mean,
yeah, it's at 71 or 72 right now, which is great. Like, let it, and there are a couple things there. One is, you know, what you want to see is the best stocks, usually they will be leading the market higher, right? And so nCino's not doing that. And that's something that's really holding me back from investing. But at the same time too, you know, you're seeing, and I don't want to call it like a frenzy. It's not a bubble. I think that's a really lazy term. But you're seeing, especially SaaS valuations, really getting a little bit out of control.
Yeah.
And then, of course, you're seeing all these SPACs that are just going up 30% in a day. The market is, and maybe it's just my lack of experience, you know, over a long period of time. The market to me just seems very, very weird. And so it's almost not a bad thing that nCino is not really joining that bunch, right? And that they're really kind of under the radar and sticking to it. But I'm not going to invest until I see their relative strength, which is their performance versus the market really improving.
Which is where the technical analysis comes into picture, right?
Right, exactly. And I do still have more work to do on the fundamental side, but it's a name that's very intriguing to me. It's only a $6.5 billion market cap right now. So there's probably room there to grow given the scope of, you know, financial institution spend. So that's a name that's, you know, I think pretty exciting for me, and that may have it may earn a place in my portfolio.
Last question: What returns will you be happy with for yourself in 2021? 2020 has been blockbuster for a lot of people.
Yeah.
2021, I mean, I read Twitter 90%, 100%, 150%.
Yeah. It's a great question. It's a funny point you bring up. You know, a lot of people were touting their returns on Twitter for 2020, and you know, like it's up 150%, like you said. And you know, one thing that they don't mention is what their max drawdown was, right? And I think that it's different for individual investors versus institutional ones, right? I manage my money like I'm managing other people's money, right? Because at the end of the day, my goal is to be a money manager, right? Start my own hedge fund, be a money manager. So at the kind of expense of maybe overall returns, I'm much more focused on the volatility within my portfolio, because an LP is not going to want to handle, most LPs aren't going to want to handle a 30% drawdown, right? They're not going to be comfortable with that. So it's great if you had 150% a year, but what was your max drawdown? If you were down 40% in March, you know, like, okay, great. Like what you're doing is really just levering the beta in the market and riding the waves, right? So let me just, and so that's why I didn't tout my returns, you know, on Twitter, is because, yeah, like, even though I started just in July and I had over 100% year to date. So if you extrapolate that for the year, like 200%, I wasn't touting it on Twitter because I wasn't happy with the volatility within my portfolio. I felt like I was incurring too much volatility for the return I was getting. And so I just didn't think I was doing a great job. I can flat out say that. And I know I have a lot to learn on the portfolio management side. So with that being said, you know, what returns do I target? It doesn't matter what year. I target and I underwrite at least a 30% IRR for my investments. Why?
Pretty
Because I
good.
run a concentrated portfolio. And so if I'm going to have a stock in my portfolio, it's going to have to be in my estimation, in my best work. I'm going to have to expect a about 30% return on that investment every single year, 30% IRR. And that's not going to change. Doesn't change on the market. Now, I shouldn't say that. If we're in a bear market, it's a lot harder because I am long only, at least right now. But right now that's my thought process is I want to generate a 30% return on
Well,
every stock.
if you generate 30% return, if portfolio returns 30%, I mean, you conveniently beat S&P, you conveniently beat NASDAQ. NASDAQ has been averaging about 20%. I think if I'm not wrong, S&P probably 10, 12, 13%. So you beat them hands down, which is, I think 30% is a very, very cool performance.
Yeah, and I mean, listen, 30% would be just phenomenal.
Yeah, it's
I
phenomenal.
mean,
Yeah.
how many investors can compound that type of return over
Not many.
time?
Not many.
Not like none almost, right? Like, Peter Lynch, he had some great years early on at Magellan, but his compound rate was only like 24%, right? And he's one of the greats of all time. Even Buffett, right? Buffett's been underperforming, the past 10 years,
10 or
whatever it was.
15 years. Yeah, yeah.
So it's hard. And do I have confidence in myself? Of course. Do I have overconfidence? No. Like this, investing is very difficult. I think that the easy returns of the past year have made at least a lot of new investors not aware of that. But investing is very hard. And so do I target 30%? Yes. Would I be happy with 30%? No, I'd be ecstatic because it's rare. It's hard to do. So that's what I target. It's what I shoot for. I want only the best names in my portfolio because it's my money. The name should really have to prove themselves to me. But I'm not looking for names that are just simply, and I'm not looking to generate just market averages, right? I'm not looking to have like a 50 or 100 stock portfolio that's really just beta, right?
Yeah.
I'm really trying to outperform through stock picking.
No, I think it makes sense. And, if one is putting so much of effort reading things, then, it better count. Otherwise you just put your money in S&P, in Vanguard fund, and you just relax. But if you're doing active management,
Which is great, and that's it. Kind of we'll take this conversation full circle. I'm not a financial advisor, so this is just an opinion. But if you're not a professional investor, that's probably the best option for you, right? If on average the market's going up 12% a year, 9% a year, whatever it is,
mm,
then you're saving yourself a lot of cost. You're not paying a manager, excessive money to manage a portfolio to just get beta, right? So you're saving a lot of cost and you're in the market and you're getting a great return. 9% a year is a great return.
over a
So
long term it compounds. And
yeah, the compounding, I mean, people should just do a simple exercise of of just looking at compounding, and it's truly remarkable. And even my 401k, my retirement accounts, it's all ETFs. I don't do active investing in my retirement accounts. It's in my brokerage accounts to do the active stuff. So I think it's a great and it's the right method for those people that don't have the time to do like the deep dive research.
or just last question, Chris. So what, let's say, three top companies your pick for 2021, which people should, which you would want to keep money in, where
Wow.
where you see a good growth, three companies.
Whew. Wow. It's so let me start really quickly by saying, there were a lot of these, and there are a lot of articles and people that do like, oh, top X or like top 10 stocks of 2021.
Yeah.
I think that's a bit ridiculous because the market doesn't know, that, oh, it's January 13th, right? And like companies don't operate that, right? And so I don't think that really, and that dates really drive market returns. So I can just say more like, what are some stocks and areas that I think have the potential to outperform.
Next 5-10 years, or let's say next 5 years.
Yeah, sure. So, one area I've really been getting deep into is the semiconductor space,
Okay.
right? And there are a couple different stocks there that I think that should be a part if you're interested in semis and you want to ride that that wave. There are a couple stocks that really deserve a good hard look by investors, and one is TSM, which it's
Okay.
TSMC. It's
Next
Taiwan Semi.
is next door.
Yeah, so they're actually reporting. Today's Wednesday. They're reporting tomorrow. Earnings. Now, they've been on a great run, but I can go into a lot of detail here. Basically, Intel is having a lot of issues. Intel forever was the lead manufacturer in the space. So TSM is really going to get a big boost. That's one. And there are different ways that I would play it as well. I think that NVIDIA is the way that you're going to want to play artificial intelligence, data centers. I think that AMD is taking over on the CPU side, but also in data centers as well. And AMD is really the gaming play. That's another reason why I have exposure to AMD. I think that you can also play the semis through the software side. So there are really two major players there. It's Cadence Design Systems, CDNS. I have a position in CDNS, and the other one is Synopsys.
Okay.
So those are kind of the tools that the developers use to design the chips. And one stock that I'm really enamored with it's ASML. ASML is, and I wrote a thread on this, and I could go on.
It's a Motley Fool recommendation as well.
Yeah. Whose recommendation?
Motley Fool.
Oh, really?
Yeah.
No, I didn't know that. So ASML is they are the only company in the world that can do what they do. Their competitive advantage is that they are the only company in the world that can do what they do. And they're really kind of the most important part of the semiconductor manufacturing process. Without them, Moore's law comes to a halt. Without them, we're back like 10 years in terms of technological progress. And the entire what they do, it's called photolithography. Basically, they can create the imprints of the semiconductor design. And so what they're doing is they're finding designs and ways to fit more and more transistors on a chip, which is all what Moore's law is about. So ASML is a big one for me. And then I'm into Micron as well. I have a position there. Micron's on the memory side. There's going to be a lot of memory requirements for AI, autonomous driving, et cetera, et cetera. And then the last one, just to throw another name out there, is Texas Instruments, TXN. So TXN is on the actual analog side, not the digital side. Analog is what allows you to kind of communicate with the outside world. And it's interesting because Texas Instruments is kind of like a software as a service company in a way, because the way the sales cycle works is that you enter into really long-term commitments. And so you have let's talk about maybe a contract with like John Deere, right? A big industrial machinery company. If they have a contract with Texas Instruments over, let's call it 10 years, that's 10 years of recurring revenue for Texas Instruments, right?
Awesome.
So that's another name in the semi space that I would look at.
All right, cool. So I think that's it. And then your CrowdStrike and SCA, those stand the ground for me.
I'm long CrowdStrike in both my longer term portfolio and my actively managed portfolio. I am long C in my long-term portfolio, but not currently in my active portfolio.
All right, cool. I think that's it, Chris. Thank you so much for your time. I think, and I appreciate you giving time.